All right. Well, thank you again on behalf of Wealth Builders Investments. I'm Chad Franzen, CEO, Certified Financial Planner. Really glad you're here today. It's June 8th, 2023. We're going to be recording our June economic update. So, for those of you who do not know, we do these once a month. And really, the goal here is just to give you an update on what's going on in the financial markets and the economy and make some practical applications for what you need to be doing. And so many of you are clients, so this is a great way for us to communicate to you our viewpoints on the markets and what we're doing in helping you managing your resources, making a kingdom impact, and being good stewards of resources. With that in mind, some of you are not clients, and so maybe you've heard us through the podcast show or through Wealth Builders. We're really glad you're here, and so we'll tell you how you can find out more about our services. But either way, thank you for being here, and we're going to go ahead and jump in. Couple of rules of engagement here. We do have a Q&A chat, which you can enter your questions into, and then our team is monitoring that. So I'll speak for about 30 minutes, and then we will have the Q&A chat, and we'll go through that and answer some of the more relevant, popular questions in there. If we don't get to them all, then we'll follow up with you online on that. So if you want to learn more about Wealth Builders Investments, you can go to wealthbuilders.net, and you can learn about our team and what we do and our philosophy for investing. Well, let's jump in. I want to be respectful of everyone's time. I've got some new slides. I also have some repeat slides if you've watched us in March, April, May, and kind of been following our view on the markets. It's actually played out the way we thought, with a few surprises along the road. But let's jump in, and let me pull up my presentation slide here. Again, and feel free to ask questions in the Q&A, and we will get to those as we move through the presentation at the end. So we'll leave 10-15 minutes for questions. All right. So again, wealthbuilders.net. This is our disclosure. Again, just we're providing educational content, and we want you to obviously seek professional advice from us. We're happy to visit with you one-on-one. So we are an SEC registered investment advisor, and these webinars, monthly webinars, are for educational purposes on that. If you want to learn more about Wealth Builders Investments, we are an SEC registered investment advisor. You can go to this website here, advisorinfo.sec.gov. That's where all the registrations happen for advisory firms. You can learn more about our company and how long we've been in business and our philosophies. That's all registered. So anytime you're working with an investment advisor or wealth management company, you want to be familiar with that. This next slide, I want to do just a promo for our podcast. Many of you are already subscribed to that, and I appreciate that. So we do have the Kingdom Finance Show, and that's the slide there. And you can snap the QR code, or you can just go through Spotify, Apple Podcast, or YouTube, and you can look up the Kingdom Finance Show. And we put out a new episode every Tuesday, I believe, is when we release it. And we talk 20-30 minute episodes, but we're talking about what's going on in the markets. How do we apply those as Kingdom investors, and covering some relevant topics. I'm going to cover a little bit today on a couple of slides about something I'm going to speak on in a podcast probably next week. So you're going to get a little preview of that, which I think you'll like, particularly what's in the news with companies like Target. So that's your little teaser, but I'm going to share it with you here on the webinar. It'll be a podcast episode soon. So again, Authentic Counsel LLC, that's our parent company. We do business as Wealth Builders Investments. We are SEC registered investment advisor. And really our vision is to help you create a financial plan, create a strategy for how you're managing resources that is brings glory to God and that makes sense or brings clarity out of the chaos in the world we live in. And so I often, tell my family and friends, hey, we live in Babylon, and so we know how this ends. But when it comes to managing our businesses, managing our talents and abilities and resources, we need to be mindful that we do live in a world at war, both physically and spiritually. And when it comes to managing our finances, we need to be very shrewd with how we're doing it, what we're what we are endorsing by investing in, and how do we minimize our taxes? How do we make an impact with money now, not just when we go to be with the Lord? Amen. So that's really our heart. We talk about creating a kingdom legacy. Now, there's a lot of tools in the financial industry, from insurance to retirement accounts to stocks and gold. And I'm not going to get specific into that today, but these are just instruments that we need to have clarity on our financial plan for how to invest. So again, that's really our heart. So again, let's jump into some data. Again, I'm going to go pretty quick through some of these slides. I'm not going to overwhelm you today because I want to share a couple things on what's going on with Target and the Go Woke, Go Broke movement. So again, if you're on this webinar, you most likely, I hope, share our values for wanting to invest with what I'm going to call Christian integrity or pro values. And so what we do at Wealth Builders Investments, and if you're clients of ours, what we're doing in managing your resources is we are going to evaluate investments fundamentally if they're a good asset class to be in based on where the economy is. But we're also going to evaluate it based upon if it violates biblical ethics. And so we're very much, we call it pro values. We're pro First Amendment, pro Second Amendment. We believe in the sanctity of life. We believe in the biblical definition of marriage, and we're not going to apologize for that in our investment philosophy. So again, I'm going to cover both concepts, but for now, let me put the kind of the kingdom perspective to the side, and I'm going to finish with that. And then what I want to cover now is some data for June 2023. Again, a lot of this data is through May. So again, like I did last month, I got good feedback from you all, so thank you. I want to cover just a few of the key economic points, and I've got 4 key economic points to share today. Last month I had 5, but we'll just do 4 points today. So again, one of the big things that happened in May was the concerns on the U.S. debt and the debt ceiling and potentially the U.S. defaulting on the debt. And for those of you who have been around for a while, you know that this topic comes up in Congress every 6 to 8 years, and there's a lot of standoffs between Democrats and Republicans and on that. So McCarthy and Biden did reach a resolution to avoid the debt default, and so that eased some concerns on the U.S. debt. Again, I think we all acknowledge when we look at the amount of debt that the U.S. government has, that it is still very concerning, and it doesn't ease my concern about it long term. I personally view that headline as a kicking the can down the road, if you will, which Washington is really good about doing that, regardless of political affiliation on that. But big headline for May, the debt budget agreement was reached. Again, I don't think it really solves the long-term problems, but I don't think anyone in Washington is really after solving long-term problems. So, all right, headline number 2, the Federal Reserve, which we talk a lot about on these webinars. So I really appreciate you being here. The Federal Reserve, which is the central bank in the United States, they determine policy on the monetary system, the money system. So think of it as the flow of money. And they did vote to raise interest rates a quarter of a percentage point, which here on the chart, you see it says 25 basis points. So again, basis points 25 basis points is 1/4 of 1% on that. Now, the big question is, what will the Federal Reserve do next week on June 14th? Now, I've had a chart in here every month for the last several months, and I'm going to show it to you again here on that. We've been pointing to July has been the month I've been pointing to since late last fall. But again, the Fed did raise rates. What does that mean? It means they're tightening the supply of money in the economy. So whether you're a stay-at-home mom, you're a business owner, you're a salesperson, you're a student, this affects the flow of money. And so all of us are affected by that, whether you're buying real estate or investing in stocks or not. So really important headline in the markets for May. These other two headlines, we've talked a lot about inflation. That's one of the key things we're looking at is jobs and inflation. They're very much interwoven. And so there is a report that comes out every month from the US government. It's called the PCE report. It stands for Personal Consumption Expenditures. A bit of a mouthful, so you can see why they made an acronym. So PCE report came out. It's really the preferred metric that the Federal Reserve, the central bankers, look at when they're talking about in their meetings, what do we do about interest rate policy? So again, as a reminder, if you've been on a deserted island for the last several months, the Federal Reserve has been raising interest rates. And with the mandate that they're going to continue to raise rates until they get inflation under control and tamed down to a level around 2.5%. Now, we've been forecasting that we think inflation is going to remain very stubborn, and it has. And what you'll see on headline number 3 is that this PCE inflation index came in higher than was forecasted for the month of April. Again, they report these in arrears, so the May report will come out at the end of June on that. So it was 1/10 of 1% higher, not a lot higher, but it did not go down. So again, just another proof that the Federal Reserve is going to have to remain very vigilant, very um, uh, really hawkish on how they're approaching interest rates on that. To me, headline number 3 says interest rates are not going down anytime soon. All right, headline point number 4. There's been a huge rally in technology stocks in the stock market. So the NASDAQ is what we most often think about when we think about technology stocks. There's been a massive rally last year, for frame of reference, in 2022. Stock market was down across the board significantly. Bonds were down significantly. Gold was up a little bit. Crypto, digital currencies were down significantly last year in 2022. Energy was getting popular. Fixed income was starting to become popular because rates were starting to go back up. Energy did quite well. We talked about that last month on the webinar about Warren Buffett and how he had been accumulating significantly more shares in a couple of energy companies. And we like to see where the smart money, the big money goes. And so that was something we talked about last month on that. So NVIDIA has led an AI tech rally. NVIDIA stock was up 25% the day after their earnings this past month. And more or less technology, I'm going to show you a chart here in a minute that I actually just found recently, has really fueled tech stocks going up dramatically over the last 6 to 7 months on that. In fact, it's really reached a extreme sentiment, and it's almost like if you're a company and you're in any way involved in technology, if you go on your earnings report or your quarterly conference calls with the analysts and you say AI, your stock's going to go up the next day on that, which is that's headline number 4. So a huge technology rally in the stock market fueled by, hey, just say AI. Well, let me show you this chart here. This chart is one that shows money going into technology stocks. And I want to draw this to your attention because On this particular slide, this blue line, and again, we're going to look at the right end where I have it circled in red. That is money going into technology stocks. We call it flows. So inflows is money going in, outflows is money going out. And so really a baby bubble has started to form in a lot of the technology stocks. And this was an article that came from Bloomberg, and ending through May 31st. So this is current. There was a record $8.5 billion that went into technology companies. So whether they were through mutual funds or ETFs or direct investments on that. So you can see how high this blue line has spiked. So that's a bubble that's creating. So it's a euphoric. Everybody wants to go through the door at the same time. Oh goodness, let's get into more technology, AI. And this is a familiar story because these things dramatically go down. You'll see if you look at the bottom there, on the right where it says 2022, where my cursor is, you'll see that flows were negative. So coming out of COVID, most people were getting out of technology, right? They were getting into dividend stocks, or they're putting their money into cash or gold, or they're looking at utility stocks, things that would pay a dividend, be a little more conservative. Um, but huge baby bubble forming there with technology on that. So what goes up quickly comes down quickly. And so that's something we want to be aware of. Um, that's okay if you're day trading stocks or trading them week in, week out. That's not our philosophy. We really want to know what we own, have it go through our pro values biblical filter, and then own it. We want to commit to owning things for 2-3 years at a time on that. So, but that's definitely an important point to point out. And this next screenshot here from a Twitter feed, one of the research analysts I follow. Hey, my son loves Legos, so why not put some Lego figures in here today? As this slide says, this was an article from the street.com, real money. But investors have a habit of getting really excited about something just at the time when it's peaking, right? And then they also fall out of love with investments or asset classes just when it's bottoming. And so, smart money, we want to be wise when we're talking about investments. So when the media starts covering something, or a neighbor says, "Hey, I just made this money on this," um, the typical behavioral response for everyday individuals is we try to chase that, and so we buy high and we sell low, and that's not what we want to do. So you have the different Lego figures faces there of, like, maybe when you're really upset that a certain asset class is down, that actually might be the time to be buying it, what we call a transfer of wealth. And when things are up, like AI stocks, if you own them in your portfolio, maybe it's the time to trim them. I actually own some NVIDIA personally, and I sold some of it based on this recent run up. So I don't want to be overly greedy. I want to take profits when it's up really high, and that's the mindset of behavioral investing for that. But again, one of the things we do at Wealth Builders Investments is we want to help be a buffer between you and making good decisions and bad decisions. We want to have you make more good decisions than bad, so that you come out ahead with your finances. So anyway, interesting point given where we are in the economy on that. All right, I'm going to show some market stats for you right now. Let me go ahead and pull a few of these up. We talked about the stock market being having a pretty good rally here recently. Let me just put some numbers up for you here. And okay, so let me get them all up there. Okay, let's leave that. Okay, so let me talk a little bit about stocks for now. So the S&P 500, again, just to give everyone a barometer. I know you don't watch it every day like we do. It's only about 11% below its all-time highs, and so the S&P 500, the 500 largest traded U.S. companies, The index is sitting a little under 4,300, only 11% below its all-time high. So if we were having coffee together and I said, well, hey, I see Travis, if Travis, you and I are having coffee together and we're like, hey, how do you feel about the economy and what's going on geopolitically and interest rates? And, gosh, do you know the stock market's only 10 or 11% off its all time highs? Would that make us want to be a buyer or a seller of stocks right now? So, I mean, it's a good question, right? I mean, I would say strategically, we're probably would want to sell into the strength of the market. I think there's more headwinds. Billy Epperhart, my business partner, and I have talked about on different webinars. We think the stock market can easily see, and I'm kind of giving you some of my comments that I'm going to make at the end, but I'm giving them to you now. Easily could see the stock market having a 20% decline just based on interest rates and what's going on in the economy and these asset bubbles on that. But crazy to believe we're here in June of 23 and the stock market is not that far from its all-time highs. I would be a selective buyer and a more opportunistic seller right now. Again, it's case by case. Again, I'm sharing just some ideas. Each of you are in a different place. So I want to encourage you, reach out to us if you want to know specifically what you should be doing. It depends on when you buy things. The VIX, let me point out one other stat here and I'll bring up the bonds. The VIX is a measure of risk or a measure of volatility. And so the reason I like to look at the VIX, the VIX, is it tells me how much implied volatility is in the market right now. And that's stocks, that's bonds, that's interest rates, that's commodities. It's a really good barometer. Anything below 20, if the VIX is below 20, it is less volatile. Now, if the VIX gets over 20, then that's a higher rate indicator of coming volatility within the next 2 to 4 weeks on that. So right now, the VIX is low. I think it was around 19 or 20 last month when we did our webinar. So the VIX around 13, 14, that means pretty low volatility. We're heading into summer. We may not see a lot of volatility this summer, but my prognosis for the fall, I think, is going to be different. So that's an important indicator to look at. Bonds, here's the current rates on bonds. You'll see the 6-month bond is paying 5.38, and these are all U.S. government bonds. The 2-year bond is paying 4.5, and the 10-year bond is paying 3.71. Now, these rates change every day, right? So I just pulled these this morning in preparation for our call. Now, what that means is that if we invested $10,000 in a government bond, similar to a CD, right? 6 months, we would earn 5.3, 5.4% on it. If we lent our money out for 2 years, we'd get paid 4.5%. If we lended it out for 10, we'd only get paid 3.71. So basic economics is that the longer you commit your money out to an investment, the higher rate of return you should receive accordingly. So these numbers, if I showed you the chart, which I'm not going to today, this is what we call an inverted yield curve. All that means is that short-term money earns more than long-term money. All things being equal, Economics 101 would say short-term money earns less than long-term money. Long-term money earns more because you're committing the money out for a longer time period. So this is an inverted yield curve. Now, if you are doing cash management, which we talk about with a lot of you who are our clients, we talk about, hey, we want to protect your capital. We want to keep it up with inflation. Then we're going to be investing with more of a 6 to 12 month time horizon. So if your clients, those are things we're talking about with you. If you're not a client, those are some topics that you want to be aware of on that. So we don't want to go commit our money long term because it's not going to get us anywhere near keeping up with inflation on that. So now, one other point on bonds. The bond market is a very good indicator for when recessions happen in the United States. So, of the past 11 recessions in the United States, uh, all 11 recessions were accurately predicted by what's called the bond yield curve, which means when short term bonds start paying higher than long term bonds, which is what's been happening here for a year now. Um, a recession it will occur in the next 6 to 9 months. And so that's a those are two key takeaways from what's going on in the bond market. Not to get super technical. One, recession is likely and imminent in the next handful of months. Two, for cash management, we want to keep it short term, 6 to 12 months. Let me just throw up a few other prices. Gold, silver, Bitcoin. These are different asset classes that we invest in. Um, Bitcoin and silver and gold have been pretty steady over the last 30 days. Gold's come back down. It was near all-time highs over 2000 for that. And the price of oil has been in the low 70s. We do think likelihood of that going up is probable here in the summer months for that. All right, I'm going to keep working through some slides. This is a slide that I showed last month. It's called the Buffett indicator. And for those of you who haven't seen it before, this is a chart made popular by Warren Buffett of Berkshire Hathaway. And what it's looking at is the overall stock market fairly valued, overvalued, or undervalued? And this was a chart from February, and we showed that again, this trend line you see in the middle of the chart where it says historical trend line right there in the middle, that would be fair value or par. Okay, anything below the trend line, and in this case, below it, you see those green dotted lines, that would be it being undervalued. So if it's undervalued, it means you're getting more bang for your buck when you're investing in companies. Now, when it's above this trend line, orange and red, it means you're paying more for assets, which has certainly been true in real estate and stocks the last few years. And you're to some extent you're going to be overpaying for those assets compared to their long-term value. So that's what the thing was. The chart was in February. It was about 170%. So it's about 32% higher than the trend. And then this is the Buffett indicator. I pulled it off the charts this morning. It's still high, right? In fact, it's a little higher than where it was in February, but mainly because of technology stocks doing what they've been doing. So again, this chart's a little cleaner than the first one. Um, for those of you that we manage your stock portfolio, again, at Wealth Builders, we're doing all sorts of assets in an investment portfolio. We don't just do stocks and bonds. We think we really need to be diversified in 6, 7, 8 different asset classes. But again, stock market is certainly something we want to have in there long term, but we don't want to just buy and hold and never make active decisions. But you'll see that blue line. We really would expect that to come down. About halfway to the fair value line, to that dotted line. I don't know that it'll make it all the way to the dotted line, but I do think what we're planning for is just selectively holding stocks and looking for some better buying opportunities once this blue line comes down. Let's say halfway to the gray dotted line. So again, so stocks overvalued doesn't mean you don't own them. It just means you need to be selective. You certainly don't want to be too overweight in certain volatile asset classes like technology. Even though they've gone up quite a bit, they can come down in a hurry. So that's the Buffett indicator. You can go Google that and read more about it. It's a good way just to get a pulse on what's going on with the markets. How are they valued? Fairly valued, overvalued, undervalued? So all right, well, let's jump into the Federal Reserve. So I've got a couple more economic slides, and then I'm going to pivot to some pro values, go woke, go broke slides, and then we'll do some Q&A just to give you an idea where we're headed with the rest of our time. Really appreciate you being here. Again, you can visit us online, wealthbuilders.net, and I'll also give you a link for getting a free download on our Pro Values on. Feel free to enter questions in the Q&A, and we'll get to a handful of those here at the end. So this slide, the Federal Reserve Bank, this is a big indicator. So whether you are a farm owner, a landowner, whether you're a business owner, whether you operate a fast food franchise, whether you're an employee for a company, we all need to know what the Federal Reserve is doing with monetary policy because they're shaping the flow of money as it comes in and out of the economy. It's called velocity. So the velocity of money through the economy that affects real estate. It affects farming. It affects franchising. It affects manufacturing, technology. It affects ministries, right? So what you see here on this chart is that so far in this year, 2023, the Federal Reserve has met a handful of times. They met February, March, and May, and they've increased interest rates a quarter of a point every time. And we had the banking crisis, which we've covered a little bit, the regional banking crisis, Silicon Valley Bank, and some others on that. And the Federal Reserve meets next week, June 14th. And you see I have in here pivot or hold. And so that next week is going to be a real telltale sign for the Fed is going to have to show us their cards, if you will, what they're going to do. The markets seem to believe the Federal Reserve is going to pause and stop raising interest rates and even start lowering them. I will tell you that I personally do not believe they're going to start lowering interest rates anytime soon. The reason is two reasons for me. Inflation is still stubbornly high, one, and two, the job market is still high. And so those two things are what the Federal Reserve is looking at. So again, we're really going to be looking at this, what happens next week, whether they're either going to not raise rates or they're going to raise it a quarter of a point. And there'll probably be a mix on the votes. They vote, and they don't have to have a unanimous decision, but they have to have a majority vote on that. What we've been saying is July, September, these dates, July 26th, September 20th. Between these two meetings, I think this is when we're going to see some volatility pick up because the Federal Reserve historically over tightens interest rates, which leads the economy into a recession. And our vote right now, now they didn't ask us, but our opinion and how we're managing resources for families is we're expecting increased volatility in the markets as we come out of summer and into the fall, and particularly around this September 20th date on that. So again, this is very connected with asset prices, with purchasing power for businesses, with inflation of goods for business owners on that. So check in next week, and we'll see what they do on that. So that's going to be that'll tell us a lot of how we're going to invest going into the fall, but we're waiting for opportunities because we do think they're going to over tighten. Well, hey, I want to transition here to our Pro Value segment, Go Woke, Go Broke. I shared this last month. We talked about Budweiser and Bud Light, America's beer, which has gotten sucked in to the liberal agenda culture and has lost significant market share. It's been all over the news, so I'm sure you've seen that. Well, in this month's installment, I'm going to talk about this month who's losing a lot of money because of their liberal stance in the marketplace on that. So again, I'm going to pivot here to Pro Values to wrap up my presentation, and then we'll do some Q&A. So feel free to get your questions in there. And I'll finish with a couple of just thoughts on the economy as we wrap up. So following in the footsteps of Budweiser is none other than Target. And so they now have decided to go full force with the liberal agenda, including hiring Satanist clothing designers from Europe to manufacture children's clothing, promoting gender confusion and tuck-friendly swimsuits. And so there's a picture from Target. Here's a picture of the infant toddler clothing, targeting innocent children into confusion on gender and identity. And Target's taking a really strong stance on this diversity, equity, inclusion movement, and they're just going to look to brainwash children right out of the gate, even when they're wearing a onesie. So what has happened is Target has faced a huge backlash because of this. It's just really a violation of innocence. And as Christians, as those of us who want to adhere to biblical policies, biblical principles, this is just not something that we can stand behind. So one of the questions that I wanted to answer for you today is, well, hey, I think we should be boycotting Target with spending there. Now, I know we're in Babylon, and I get this question all the time. Well, it's everywhere. Walmart does it, Kohl's does it. I get that. But at some point, if as Christians we start a movement of boycotting certain companies to get their attention, then Budweiser, Target, then that starts to have other companies say, "Hey, maybe we don't need to be so involved in this on that." So I think a boycott of Target is well underway. Target's CEO, he warned that the company was expecting to lose $500 million this year, blaming crime and theft. That was in May, this last month. That's interesting. However, since Target reported earnings on May 17th, the stock has dropped about 20% through the end of last week in its value. Now, it is not because of store theft. I think we all know that people are recognizing just how obscene this is with what Target is doing, particularly with children's clothing and the apparel wear. So this is something that I want to encourage you to be aware of with your investments. So, Chad, what does that mean? What it means is I'm going to show you right now, and this is going to be on a future podcast. I'm going to show you who the top companies are that own Target stock. This is important. Okay, so this slide here, these are the top institutional owners of Target stock: Vanguard, BlackRock, Bank of America, Wells Fargo, JP Morgan. Okay. So we need to stop investing in these companies. You need to stop doing business with the JP Morgan, Wells Fargo, B of A, BlackRock. We need to stop investing in those Vanguard funds, right? Because these are the institutional investors who are investing in Target, right? So I think it's good for us to stop shopping there, but we also need to stop investing with these companies. This is the behind the scenes look at what companies are owning the stock. They're voting to put board directors in their place, right? What about mutual funds? Many of you own mutual funds through Edward Jones, through your 401k, through Merrill Lynch, through wherever. Here are the top mutual funds that own Target stock. So if you have money in American funds, Vanguard, Fidelity Index Fund, the Spiders, here's the list here. These mutual funds own significant hundreds of thousands, if not millions, of shares of Target. So this is how we continue to boycott companies that are woke. Is we say, hey, we're not going to invest in our mutual funds that are buying Target, that are voting to put really liberal people on the board of directors. Now, we're going to send this list out to you so you'll have it. If you have questions on this, reach out to us after the webinar. But I want to encourage you, and I really want to kind of plant the flag here, the kingdom flag, that we have got to get a kingdom perspective on the mutual funds and the companies we're investing in. So I'll give you the list. These are the companies that support Target. And so if we can rally together and take our money out of these companies, out of these mutual funds, and not work with companies that own Target. There are a lot of banks, a lot of the big banks invest in Target. J.P. Morgan, there's one right there. Wells Fargo, B of A. Um, that is a second leg of how we fight this battle. And we call this biblically responsible, pro values, and social impact investing. That's really our three-tiered strategy at Wealth Builders Investments: biblically responsible, pro values, and social impact. Now, I'm not going to drill down on what each of those mean, but I've just given you a really good example of target and, well, how do we respond? How do we respond when we live in Babylon with managing our money on that? So we do have a pro values index. If you don't already have it, I want to make it available to you. We do have a link in the Q&A, wealthbuilders.net/invest, and you can get our current pro values index. It's a list of the top 30 companies that we are boycotting, such as Target, and a top 30 list of companies that we are promoting that do not violate biblical principles, that we are investing in, that are not completely woke on that. So I really want to get that pro values index in your hand if you don't already have it. So you can go to wealthbuilders.net/invest. You'll put in your name and email. You get an automatic email directly sent to you. I want you to talk about that with your family, with your spouses, with your friends, your community groups, your friends at church. If we can get the word out of, hey, we need to avoid these 30 companies. Even if you're not investing or working directly with our team, I want to give you resources that you can go out and make a difference for, hey, how to educate people on, hey, here's some companies we got to avoid spending and investing in. And here's some companies we can support that have Christian CEOs, men and women who love God, who have corporate chaplaincy in their companies, who have biblical principles at work every day. That's how we start a movement for kingdom impact investing. So again, wealthbuilders.net/invest. And let me wrap up here and then we will go to questions. So I want to just summarize kind of my thoughts on the market. Again, we think a recession and a stock market drop is most likely going to happen in the fall. I want to remind you that interest rate increases, they're not fully reflected in the economy until about 9 months after they happen. So that's still working its way through the system. And again, Federal Reserve, that's what we have to watch. We've got the meeting coming up June 14th. This is a repeat slide. Again, these are the things we're watching at our team: stagflation and recession, geopolitical risk, and then the job market. Stagflation just means that the economy is slowing down while inflation is high. And we think that's what's going to lead to recession as we head into the fall for that. All right. Well, I am going to open it up to Q&A. Again, there's the Kingdom Finance Show podcast. I think I already showed that to you all. So let's see what questions we have. And, one of the things Caleb, who's on my team, he and I have done a lot of is if some of you are invested in the markets and you're not sure, or you want to get a second opinion on, well, I don't know how exposed I am to Target. I don't know. I don't know what I don't know, right? I don't know what questions to ask because I don't follow this the way your team does on that. One of the things you can do, you can reach out to us and we'll do a complimentary, we call it an X-ray because it's a good visual of, if you've got a 401k or retirement account and you just want Caleb and I and our team to just, hey, give you just an assessment of, hey, how exposed am I to companies like Target and BlackRock and JP Morgan? Sometimes because you invest in funds, you don't even know if you are supporting those companies because you don't own them directly, you own them indirectly. And so that's one of the big things that we do. So if that's of interest, we call it an X-ray. You can send us an email and say, hey, I'd like to get a financial X-ray of my statements. And again, you can also respond to us. For those of you who are not clients, if you want a complimentary consultation, we'll be happy to provide one. Just reach out to us through the website's the best way to connect. You can respond to us from the email as well. We'd be happy to do a complimentary consult. For existing clients, we really value your feedback. And again, if you have specific questions on your portfolios, on your financial plan, again, it's not only about picking the investments, it's about having a plan, a strategy, right? So we want to know, you know, what age and stage you are. What are you trying to accomplish? Like, what's your background with money? What's your background with business and employment? And so that's something it's very customized, right? And so I want to encourage you, if that's something that you haven't done in a while, or if you just want a second opinion with what your current advisory firm is doing, we'd love to assist you with that. And again, in closing, really want to thank you all for being here. Again, at Wealth Builders Investments, our goal is to help you protect your money, invest with kingdom values, and um, bring clarity out of chaos with what's going on in the economy and the markets. And so, thank you for those of you who are clients. We're really glad you're here. This is a great way to stay in touch with what we're thinking on the market. So please make sure you're checking in with these once a month webinars. We also have the podcast. So we have a new episode drops every Tuesday. That's really the best way we're finding to keep ongoing communication with you. And so thank you all for being here. On behalf of our entire team, I want to thank you for your time, and really thank you for your desire and your commitment to be a kingdom investor. Because you being here, whether you registered and are watching this on a delay or you're here live, I want to acknowledge that the Holy Spirit's moving in you, to manage your resources, manage your businesses in a way that is purely kingdom. And we're excited to encourage you along that journey. But I just want to acknowledge that the more of us that are doing this, that we can make a difference. And so, blessings to each of you, and we will see you next time. And thank you so much. Have a great day.